Hello everybody, welcome to episode 1 on timing the market. In this video I'll be showing you guys a trade model that I use during a specific time of the day. It occurs every single day and there are multiple ways that you could trade it. I'll be diving into those and I'll also be showing you guys an example of me trading it live in this video. So between the 9 to 10 o'clock hour, this is the specific time window that we're working within. There is always an entry model that forms between this 60-minute period. Okay, there's a few elements of time that I will consider. We have the 9 a.m. power of 3, which is marking out the 9 o'clock open. Okay, looking for accumulation, then manipulation above or below, depending on what your bias is. Okay, you also have the 9:30 volatility injection. So at 9:30, price will spool for liquidity typically. Okay, and then we also do have the end of the 850 to 910 macro and the start of the 950 to 1010 macro. This is not as significant to me, the macros, because I don't typically use them, but sometimes during those time periods, you will get price running for liquidity or running for inefficiency. Okay, so within this trade model, we are always trading liquidity to liquidity. Okay, so a high or low is considered liquidity. So above old highs is considered buy side liquidity. Beneath old lows is considered sell side liquidity. If you're new, I'll explain what that is. But fair value gaps are also liquidity as well. Okay, so I did do a poll on Twitter recently discussing what makes a fair value gap significant, and most people said it's the fact that it's inefficient delivery, when in reality, fair value gaps are only returned to because on a lower time frame, it's also liquidity. Okay, so the third thing within this model, which is the most important, is having a key level where the model forms at, but then also a higher time frame bias. So you need an overall direction of where to look for the model to form in the direction of. Okay, so there's always an entry that forms within this 9 to 10 o'clock period. Does it mean that the exit is going to be within the 9 to 10 o'clock hour? No, it does not. Okay, so let's dive into what I look for within this 9 to 10 o'clock period. There are only 3 things that I look for, and it's always liquidity to liquidity. So it's important to understand external range liquidity and also internal range liquidity. A fair value gap is considered internal range liquidity. An old high is considered external range liquidity. An old low is considered external range liquidity. Okay, so there's 3 things that I'm looking for. Again, I'm only trading turtle soup personally within this time period, but once price is in the expansion phase, once it's already heading for that liquidity, okay, there are other ways that you could trade it, which I will be diving into, but first we're going to focus on the turtle soup aspect of trading 9 to 10 o'clock. Okay, so the first way you could trade it is you're buying a fair value gap within the 9 to 10 o'clock period and targeting liquidity. Again, the entry is going to form within 9 to 10 o'clock. The target does not have to hit within that time period. This is the first model that I look at, okay? It's not always going to be there. There's other variations, but this is one of them. A fair value gap to an old high. Okay, the second variation would be external range liquidity to external range, which is just liquidity to liquidity. So you look for price to run buy side and then take out the opposite end of the range, which is sell side, okay? The next one is external range to internal range, where you're trading above the high and then targeting the fair value gap. So there's 3 ways. It's either a fair value gap to buy side liquidity, okay, or fair value gap to sell side liquidity. You also buy side to sell side, or vice versa, sell side to buy side. And the next one is buy side to a fair value gap or sell side to a fair value gap. So those are the different variations that I will look for within this 9 to 10 o'clock hour. Again, there is always an entry model that forms within this hour. At 9:30, okay, what price can do is it can spool to that target, or what it can do is around 9:30, it drops back down, purges some form of liquidity, and then it heads for that target. So that's typically what will happen. Either 9:30 will take you to the area where the entry can form at. That volatility will start to spool lower to that level. Okay, and then after that, it kind of acts like a Judas swing. This is where the 9:30 Judas swing model comes into play. Okay, most of the things that I'm sharing with you here, I give credit to ICT. Though he never talked about a model between 9 to 10 o'clock, he has talked about trading within the kill zone of 8:30 to 11. Okay, so this is me refining the concepts that I've learned from him and coming up with my own model, which is ultimately what he wants us all to do. You know what I mean? Be independent with your thinking. So this is the 3 entry models that I look for within this hour. Let's move on to the next slide here. Here's an example of marking out the 9 o'clock to 10 o'clock. I know it does all seem like hindsight and it does seem like a very basic model, but as this video goes on, I'm going to get more complex and more specific. So it is important to have your notepad out and just be paying attention, because this is just the simplest form of looking at this model. It's going to get more in depth. Here is trading a fair value gap to liquidity. So within this time period of 9 to 10 o'clock, price retest this specific fair value gap. Okay, and I'm going to show you guys what makes this model significant later in this video. So this would be trading the fair value gap to buy side liquidity. So this is one variation of the model. Between 9 to 10 o'clock, the entry model will always form. You do not have to wait. Here's the beauty of this model. This entire move down can be an entry model in and of itself. Look how price took out this old high and then displaced towards the fair value gap. Okay, so this manipulation down, there are ways to trade that manipulation into the key level. Okay, we're not going to be focusing on trading it down to the key level, catching the bottom, trading it up to the high. Okay, because that's unrealistic at first. It doesn't mean you'll never be able to get there in the future, but now we're just focusing on one entry model within this time period. We're looking for the clear structure. You're not going to catch it every single day. That's important. Okay, but it's there every single day. So knowing that it's there every single day should reduce some FOMO, because if you miss it one day, okay, I'll come back the next day and I'll know that it's there. So this is trading a fair value gap. You're entering once it taps into the fair value gap. Stop loss could be beneath this swing low down here. It's not just any random fair value gap. I'll show you guys what gives it significance later in the video. We have the 9 to 10 o'clock period entering in the fair value gap, targeting the old high. Okay, let's move on to the next variation. This would be trading a turtle soup above external range liquidity. So we have this old high right here. Okay, you would draw a line out from there. You're shorting above the old high and targeting the fair value gap. Okay, you could enter within the 9 to 10 o'clock period. You're entering up here and you're targeting the fair value gap. Again, this one is not exiting outside or inside the window of 9 to 10 o'clock. Within this model, that's not the purpose. The purpose isn't to get in and out within that 1 hour period. The purpose is to get in within that 60-minute period, and then you get out once the draw on liquidity hits. So the draw on liquidity hits here. And I know looking at this, it just seems like, yeah, that's very easy to look at in hindsight. I'm literally going to show you guys a video of me top ticking using this model, trading it live. Okay, and then I'm going to show you guys what gives it significance, because anyone could go in and mark out any random fair value gap, any random level of buy side liquidity between the 9 to 10 o'clock hour and make a video about it. Okay, but I'm going to show you guys why this is so significant. So this would be trading an old high to a fair value gap, trading buy side liquidity to a fair value gap. Now, when I did run that poll on Twitter, 99% of people, sorry, not 99, it was about 75% of people said what makes a fair value gap significant is the fact that it's inefficient price delivery, which is what ICT teaches. Okay, so we have this high right here, and then we have this low. Okay, so what ICT teaches is that there's inefficient price delivery. This is a BISI fair value gap, a buy side imbalance, sell side inefficiency. It is inefficient in sell side delivery. Okay, it's just delivered one way, which is up. So price typically reprices back to that, and then it can go higher. What really makes a fair value gap significant is this low right here. Okay, because this is on a lower time frame. If you scale down to an even lower time frame, you'll notice that this low is sell side liquidity. Okay, so when price goes beneath there, okay, if you truly are bullish, it really won't dig into the lower end of that, because this is sell side on a lower time frame. So price will tap it and then it'll just run exactly what it does here. Okay, so that's what truly makes a fair value gap significant. The low of it in a BISI fair value gap, which is a bullish fair value gap, or the high, okay, in a bearish fair value gap or a SIBI. Okay, so let's move on to the next one. This would be trading external range liquidity to external range liquidity within the 9 to 10 o'clock hour. Price goes above an old high. You're selling above that old high, targeting the opposite side of the range. I know you have all these questions right now. How do you know if it's going to go to the external range or just go to the fair value gap? I'm going to be answering all those if you stick along. Okay, so you're entering within that time window of 9 to 10 o'clock. You're targeting the opposite side of the range. Now your question, how do you know if it's just going to target this fair value gap here or if it's going to run all the way lower? okay, because you don't want to just get out here if it's going to continue to move lower, okay, and that's going to happen sometimes. But what really shows you if it's going to move to external range liquidity or just stop at a fair value gap right here is your higher time frame bias, okay? If the higher time frame bias is for price to trade lower, we're in a bearish trend, order flow is bearish, you're going to likely hold for external range liquidity. If you think price is in a short-term sell program, but it's overall bullish, there are ways to trade it just back to the fair value gap. So it really all comes down to higher time frame bias in order to understand if it's going to head for external range liquidity, which is again a high or a low, or internal range liquidity, which is a fair value gap within that high to low. Okay, so this entry model forms every day between 9 to 10 o'clock. Here's today. So this is just me marking out the 9 to 10 o'clock hour, right? There's an entry down here and also an entry down here. So sometimes there are two entries within that time period. We exit once the draw on liquidity hits. It does not have to be within that time window. Now for the real sauce. So now all the people that got bored, they left the video. So now it's time for me to show you guys what's extremely important about this model. Every single day between 9 to 10 o'clock, there is a time-based SMT that forms, okay? So within 9 to 10 o'clock, there will always be, I don't care what anyone says, there will always be a cracking correlation between correlated assets. So between this time period, you need to be comparing the NASDAQ to the S&P 500 and also to the Dow. So you need to compare those three averages. Once you see a cracking correlation within this time period at a specific level, what's that specific level? Could it be a fair value gap? Could it be an old high? Right? I showed you three different variations which it can be. Okay, once you have that SMT, okay, that's when expansion can occur. So if we look at this between 9 to 10 o'clock, now again, you need to have a higher time frame bias. You need to have a key level where price can reverse at, and then all of this information I'm showing you guys becomes insanely precise. I am showing you guys the pattern to look for within this time period. What unlocks it is the key level and also the higher time frame bias. So in this example, okay, the higher time frame bias today was bearish. Okay, it was to reprice back lower for the sell stops. When price pulls above this old high, between this high, and I'm going to leave this for your own study, I'm not going to compare it on the screen right now, but between this previous high right here and this high that swept liquidity, there was SMT divergence. So if you look at the S&P 500 and the NASDAQ and the Dow, you're going to compare this high right here. Okay, so this was the highest high. You're going to compare that to the Dow and also to the S&P 500. You'll notice that NQ made a higher high. This is SMT divergence for anyone that's new. I'm going to make it very, very simple because a lot of people don't fully understand it, but for some reason they want to teach on it. Okay, but I'm going to show you guys that it is dead simple what you're looking for. Okay, this is the Dow on the left side. This is the S&P 500 right here. This is the NASDAQ. This is a cracking correlation between correlated assets. They should be moving in sync. When they don't move in sync, it shows that smart money is active. Okay, there can be false SMTs. That's important. Okay, so when you have a higher time frame bias and you use this in the direction of that higher time frame bias, SMT becomes flawless at that point. If they are all moving in sync together, they should all be making a lower high right now. What does NQ do? It takes out that previous high. This is a cracking correlation. This is what we call bearish SMT divergence. Between the time of 9 o'clock to 10 o'clock, every single day, you will have this between 9 to 10 o'clock. It does not have to be external range liquidity SMT divergence. It could be fair value gap SMT. Okay, so that's a thing, which I'll be diving into in a minute. This is a bearish SMT divergence. This right here, let's just remove this. This is now a bullish SMT divergence. These made a higher low. These made a higher low, this made a lower low. This is a Kraken correlation between correlated assets. Between 9 to 10 o'clock, there will always, I don't care what anyone says, there will always be a Kraken correlation, okay? Because smart money, and the reason that we're using this 9 o'clock hour, between 9 and 10 o'clock, is because number one, we have the 9:30 volatility injection. Smart money is always trading at this time. That is why I love this time window. And I'm going to show you guys next an example of me using this model live. Okay, so price takes out the old high between the 9 to 10 o'clock hour. It takes out this level of buy-side liquidity. So taking a turtle soup trade would be when price taps into the higher time frame level of liquidity within this time period. Okay, so this is just a spool up to take it out. You're shorting above this previous high. Okay, as soon as it runs that previous high, where could your stop be at, Dan? It could be at a high above that from the left side of the chart that it's likely not to engage. Okay, so this previous high right over here does not get engaged. Okay, it just barely doesn't get engaged. Or it could be, you could even have a safer stop and have a couple highs above there. But this is the entry right in here. Now, you do not have to trade it like this, okay? So taking a turtle soup trade would be price runs above that old high. You're shorting as soon as it takes out that old high, but you need the SMT divergence. So that is key in understanding this model. So the SMT above that high between 9 to 10 o'clock, where can you be targeting? If you have a higher time frame bias that's lower and you know that this is likely to get hit based on the higher time frame, you can hold for these levels of external range liquidity right here. Okay, I'm just marking out a rectangle, but normally I draw out a horizontal line on these lows. You could be targeting that. If you are not sure, you could target a discount fair value gap. If you're not sure if it's good, if you think it's going to be bearish, okay, it reaches a key level where you anticipate a reversal, right? But you're not positive if the higher time frame bias will take us all the way lower, or you could enter or you could exit on a discount fair value gap. Okay, if your higher time frame bias is lower, you're holding for external range liquidity and potentially even all day. Sometimes the hour between 9 to 10 o'clock, it'll form that manipulation up, and then price will look like a classic sell day where it's just reaching for a higher time frame level the entire way lower. So between 9 to 10 o'clock, there is always an SMT that forms that will take you from liquidity to a fair value gap, or a fair value gap to liquidity, or liquidity to liquidity. In this example today, this is an old high, which is external range liquidity, and then it runs back down for external range liquidity over here. All right. What would be an example of a fair value gap SMT? Well, that would be something like this between this time period. Okay, so price forms a fair value gap, right? Let's say this is the NASDAQ right here. This pulls back down. Let's just say this is the lower wick on that, right? A bullish SMT out of a fair value gap between the 9 to 10 o'clock hour would be a fair value gap that forms. Price pulls back down lower. Okay, one of the assets, whether it be ES or YM, take out this low and tap into the fair value gap, whereas NASDAQ doesn't. Okay, and it just stops, and then it starts to spool higher. So you have a lower low in the fair value gap on YM, we'll say, or ES, and then NASDAQ doesn't. So this would be a fair value gap SMT. Okay, if there was that in this example, then you could be targeting buy-side liquidity. Okay, so that will always form within that time period. Okay, this is what unlocks the model. Having a higher time frame objective where price is reaching for. For example, on a 4-hour time frame, price is reaching for a specific level, whether that be a fair value gap, whether that be a level of liquidity. In line with that, you have a key level in order flow aligned with the higher time frame objective. Then you combine this 9 to 10 o'clock period. Then you combine an SMT confirmation within that 9 to 10 o'clock period. One more thing before we move on. The 9 to 10 o'clock period, it doesn't have to form the SMT within that time zone. It could be from a high or low outside of that time window that forms the SMT. It does not have to be within the 9 to 10 o'clock hour, meaning you could compare a low from yesterday to the low within the 9 and 10 o'clock hour, right? But it doesn't have to be a low to another low within that 9 and 10 o'clock hour. So I hope that makes sense. Okay, so I'm not going to be diving into, this video is getting a little long, so I'm not going to be diving into how do you come up with a higher time frame bias, how to use specific key levels aligned with order flow in line with that higher time frame bias. But there is going to be a part 2 and a part 3 to this, which I will be uploading in my Discord, where I will be discussing a full checklist using higher time frame analysis to come up with a bias, also discussing the key levels. And I'll just be walking you guys through an entire checklist of how to trade this model. Again, what I shared in this video is extremely important, but this completes the model, and I will be showing that in my Discord. So there is a 3-day free trial. I did make it a 3-day free trial to my Discord. If you just want to pop in, watch the videos, and then leave, you can completely do that. That's fine. Okay. But that is where the part 2 and part 3 to this series will be uploaded. So now I'll be showing you guys an example of me trading this model live. Hello everyone, I'm going to show you guys the time-based model in action. So currently I am in a trade. This is on the NASDAQ. I just entered short above that previous high. I'm going to set my stop at this high right above this previous high. Okay, so we wick this level. I'm not anticipating for this high to get traded to again. I'm just kind of anticipating a drop into this low at 17,408. So within this time-based model, there will always be an entry that forms between the hour of 9 to 10 o'clock. So within that 60 minutes, you can always find an entry. I could hold this much longer than 60 minutes. I could hold this much longer than 10 o'clock. The purpose of this model, just to get it straight, is not that you enter and you exit within that hour period. It's that there's always going to be an entry within this hour period, okay? If I had a higher time frame bias, that price is going to drop all the way down to here, which is not what I'm saying at all, then I could potentially hold this longer than 10 o'clock. Since this is just my higher time frame bias right here, these lows, and here's a tip for you guys. Higher time frame bias does not have to be daily. You could use the hourly or the 4-hour as your higher time frame bias. So since this is just my bias, this low specifically right in here, I'm not going to be likely holding that much past 10 o'clock unless it just chops around in here for the next hour and then heads lower. So I'm going to hold until it hits the specific level that I'm targeting, which is this low. This is the original consolidation of a market maker sell model. Okay, so this was the origin. This was the smart money reversal. You have the low risk buy. Okay, I'm trading the distribution leg over here. You could also say low risk buy, distribution, second leg distribution, and now we just get a fast drop lower. Okay, so price returned above this previous high. There are relative equal highs in here. As price is dropping lower, okay, retail is chasing this. This entire move down, retail is chasing this. I used to do the same thing. Okay, what smart money will do is they'll run back on those who are chasing price as it's continuing to set new lows, and they'll leave behind these clusters of highs. So when you're trading turtle soup, you're essentially trading the opposite of what retail is doing. You're selling where retail's buy stops are. So retail would likely have buy stops at either of these highs. I'm waiting for price to run on that high. Okay, I'm entering as soon as price goes above that high. As soon as price goes above that high, I'm entering. You can see where my fill is. This is at 17,509 about. Okay, so as soon as price takes out that high, I'm anticipating for smart money to be selling to those buy stops. Okay, because those buy stops become buy orders. So smart money runs back on these highs for the purpose of filling their position. So obviously, everyone needs a counterparty to their transaction. With every buyer, there must be a seller. With every seller, there must be a buyer. So smart money needs to create liquidity. Okay, so price drops fast lower. This is enticing retail to go short. They run it back on anyone who was short, anyone thinking that this is resistance over here. They get smoked. Price pops above that high. Okay, breakout traders are going long. Also, anyone short in here, this is an obvious place to put your stop at. Those are categorized as buy stops. So we have two forms of potential buyers. They get triggered. Smart money sells to those buyers. That's their counterparty. So once you have a drawn liquidity, once you know where price is going, then you know that the purpose of the sell side of the curve is just to basically consolidate. So you'll see expansion, consolidation, then you'll get manipulation where price just takes out buy stops. and it continues in the direction of your bias. So that was the entry model that we did within this hour. Do you have to trade the turtle soup using this time-based model? No, you don't. Okay, I could wait for price to go above this key high right here, these relative equal highs. I could wait for it to create a change in the state of delivery. There's two forms of that. I could wait for it to close beneath this specific up close candle, so the up close candle that purged the liquidity. I could wait for just a singular candle close below that level. Once we get a close beneath that open, okay, you could enter with a stop above this previous high. You could also wait for consecutive up close candles to break. In this scenario, I wouldn't do something like that because I'd have to wait literally to where price is right now. Okay, that wouldn't make too much sense. Or I could wait for a breaker to form. And on this time frame, there is no breaker. But if you go down to a 30-second, you'll notice that this is the breaker. So if you can't find the entry model on the time frame that you're looking at, it will always be fractal on a lower time frame. If I see a 1 minute change in the state of delivery and price closes beneath this up close candle, there will always be a lower time frame breaker, even if it's not present on the 1 minute time frame. Because if you take a look, this is the 30-second. This down close candle here, you could also enter on that. You could also enter when price creates a market structure shift with a fair value gap. There are multiple ways to enter in here. Okay, I picked the turtle soup. All right, so I'm entering between the 9 to 10 o'clock hour. What happens if the entry forms at 10:01? Well, with this model, I'm teaching no trade. All right, so it's just if you get the entry within the 9 to 10 o'clock hour, good. If you missed it, that's okay. Journal your observations and come back another day. The goal isn't that you should be trading every single day. It's more so the fact that knowing it's there every single day, it'll reduce a little bit of FOMO, and you won't be rushing to find the next trade setup because you know it will always repeat. All right, so we're going to let this play out. I think that it's going to continue to drop into this low. I don't want to see this high ram back on, okay? If it runs back on this previous high, since it already ran out the liquidity, since it already displaced lower, at that point, I'd probably have the wrong higher time frame bias, and I'd probably expect it to run this previous high. So I would not anticipate for this specific high, since it already ran the liquidity, to get ran back on. So we're going to let this play out. Again, I will hold until it hits the 17,408.50. I'm not closing within this 10 o'clock period unless it hits the target. So I'm going to go ahead and pause and let this play out. So as you can see right there, price did hit the take profit. All right, so I waited for a turtle soup between the time window of 9 to 10 o'clock a.m. Okay, I already had a higher time frame bias. Price reached a key level on a higher time frame. Okay, and then this was our lower time frame key level. Why was this a key level? Because it had 3 relative equal highs. The bias was lower. Smart money is just going to run back on those stops before targeting the lows.